Good evening, and thank you for joining me for another Boring Books for Bedtime. I hope tonight's selection provides all the boredom your busy brain needs to quiet down and let you get some sleep. Before we begin, however, I'd like to give a special shout out of thanks to some new members of our Patreon: Jamie, Colleen, Ray, Sandy, Stephen, and Jennifer. Thank you all so much for supporting this podcast. Your help makes it possible to keep making new episodes and keep them ad-free for everyone, and it's very much appreciated. If you're interested in supporting this podcast and finding out about the perks available to Patreon subscribers, including exclusive episodes heard nowhere else, you'll find a link to our Patreon page in the show description. You can also support us with a one-time tip via buymeacoffee.com, no subscription required. I hope you'll take a moment to check them out. Now, find a comfortable spot. Adjust your volume. Take a nice, deep breath in. Let it out slowly. And off we go. Tonight, we're relaxing with some of the most boring documents ever written, publications provided by the United States Internal Revenue Service to assist you in filing your federal income tax. Let's begin. The United States Department of the Treasury Internal Revenue Service, Publication 583, Catalog Number 15150B, Starting a Business and Keeping Records. Introduction. This publication provides basic federal tax information for people who are starting a business. It also provides information on keeping records and illustrates a record-keeping system. Throughout this publication, we refer to other I.R.S. publications and forms where you will find more information. In addition, you may want to contact other government agencies, such as the Small Business Administration at sba.gov. We welcome your comments about this publication and suggestions for future editions. You can send us comments through irs.gov/form comments, or you can write to the Internal Revenue Service, Tax Forms and Publications, 1111 Constitution Avenue Northwest, IR-6526, Washington, D.C. 20224. Although we cannot respond individually to each comment received, we do appreciate your feedback and will consider your comments and suggestions as we revise our tax forms, instructions, and publications. Do not send tax questions, tax returns, or payments to the above address. What new business owners need to know. As a new business owner, you need to know your federal tax responsibilities. Table 1 can help you learn what those responsibilities are. Ask yourself each question listed in the table, then see the related discussion to find the answer. In addition to knowing about federal taxes, you need to make some basic business decisions. Ask yourself, what are my financial resources? What products and services will I sell? How will I market my products and services? How will I develop a strategic business plan? How will I manage my business on a day-to-day basis? And how will I recruit employees? The Small Business Administration, or SBA, is a federal agency that can help you answer these types of questions. For information about the SBA, see sba.gov. Table 1. What new business owners need to know about federal taxes. This table is intended to help you, as a new business owner, learn what you need to know about your federal tax responsibilities. To use it, ask yourself each question in the left column, then see the related discussion in the right column. Which form of business will I use? C. Determining which type of business to use. Will I need an employer identification number, or EIN? C. Getting a taxpayer identification number. Do I have to start my tax year in January, or may I start it in any other month? C. Designating a tax year. What method can I use to account for my income and expenses? C. Choosing an accounting method. What kinds of federal taxes will I have to pay? How should I pay these taxes? C. Business taxes. What must I do if I have employees? C. Employment taxes. Which forms must I file? See Table 2 and Information Returns. Are there penalties if I do not pay my taxes or file my returns? See Penalties. What business expenses can I deduct on my federal income tax return? See Deducting business expenses. What records must I keep? How long must I keep them? See Record keeping. Determining which type of business to use. The most common forms of business are the sole proprietorship, partnership, and corporation. When beginning a business, you must decide which form of business to use. Legal and tax considerations enter into this decision. Only tax considerations are discussed in this publication. Sole proprietorships. A sole proprietorship is an unincorporated business that is owned by one individual. It is the simplest form of business organization to start and maintain. The business has no existence apart from you, the owner. Its liabilities are your personal liabilities. You undertake the risks of the business for all assets owned, whether or not used in the business. You include the income and expenses of the business on your personal tax return. For more information on sole proprietorships, see Publication 334, Tax Guide for Small Businesses for Individuals who use Schedule C. If you are a farmer, see Publication 225, Farmer's Tax Guide. Partnerships. A partnership is the relation existing between two or more persons who join to carry on a trade or business. Each person contributes money, property, labor, or skill, and expects to share in the profits and losses of the business. A partnership must file an annual information return to report the income, deductions, gains, losses, etc. from its operations, but it does not pay income tax. Instead, it passes through any profits or losses to its partners. Each partner includes his or her share of the partnership's items on his or her tax return. For more information on partnerships, see Publication 541, Partnerships. business owned and operated by spouses. If you and your spouse jointly own and operate an unincorporated business and share in the profits and losses, you are partners in a partnership, whether or not you have a formal partnership agreement. Do not use Schedule C. Instead, file Form 1065, U.S. Return of Partnership Income. For more information, see Publication 541, Partnerships. Exception: Community income. If you and your spouse wholly own an unincorporated business as community property under the community property laws of a state, foreign country, or U.S. possession, you can treat the business either as a sole proprietorship or a partnership. States with community property laws include Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. See Publication 555 for more information about community property law. Exception: Qualified joint venture. If you and your spouse each materially participate as the only members of an unincorporated, jointly owned and operated business, and you file a joint return for the tax year, you can make a joint election to be treated as a qualified joint venture instead of a partnership for the tax year. Making this election will allow you to avoid the complexity of Form 1065, but still give each spouse credit for Social Security earnings, on which retirement benefits are based. For an explanation of material participation, see the instructions for Schedule C, Line G. To make this election, you must divide all items of income, gain, loss, deduction, and credit attributable to the business between you and your spouse in accordance with your respective interests in the venture. Each of you must file a separate Schedule C and a separate Schedule SE. For more information, see Qualified Joint Venture in the instructions for Schedule SE. Corporations. In forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions. C corporations. The profit of a C corporation is taxed to the corporation when earned, and then is taxed to the shareholders when distributed as dividends. However, shareholders cannot deduct any loss of the corporation. For more information on corporations, see Publication 542, Corporations. S corporations. An eligible domestic corporation, or a domestic entity eligible to elect to be treated as a corporation, can avoid double taxation, once to the corporation and again to the shareholders, as long as it meets certain tests and elects to be treated as an S corporation. Generally, an S corporation is exempt from federal income tax, other than tax on certain capital gains and passive income. On their tax returns, the S corporation's shareholders include their share of the corporation's separately stated items of income, deduction, loss, and credit, and their share of non-separately stated income or loss. For more information on S corporations, and the tests that need to be met to be eligible to elect to be an S corporation, see the instructions for Form 2553, Election by a Small Business Corporation, and Form 1120S, U.S. Income Tax Return for an S corporation. Limited Liability Company. A limited liability company, or LLC, is an entity formed under state law by filing articles of organization as an LLC. The members of an LLC are not personally liable for its debts. An LLC may be classified for federal income tax purposes as either a partnership, a corporation, or an entity disregarded as separate from its owner by applying the Rules and Regulations Section 301.7701-3. For more information on LLCs, see the instructions for Form 8832, Entity Classification Election. Getting a taxpayer identification number. You must have a taxpayer identification number so the IRS can process your returns. Two of the most common kinds of taxpayer identification numbers are the Social Security Number, or SSN, and the Employer Identification Number, or EIN. An SSN is issued to individuals by the Social Security Administration, or SSA, and is in the following format: 000-00-0000. An EIN is issued to individuals or sole proprietors, partnerships, corporations, and other entities by the I.R.S., and is in the following format: 00-000-0000. You must include your taxpayer identification number, SSN or EIN, on all returns and other documents you send to the I.R.S. You must also give your number to other persons who use your identification number on any returns or documents they send to the I.R.S. This includes returns or documents filed to report the following information: 1. Interest, dividends, royalties, etc. paid to you. 2. Any amount paid to you as a dependent care provider. 3. Certain other amounts paid to you that total $600 or more for the year. If you do not furnish your identification number as required, you may be subject to penalties. See Penalties. Employer Identification Number, EIN. EINs are assigned to sole proprietors, LLCs, corporations, and partnerships for tax filing and reporting purposes. See Form SS-4 and its instructions for more information and to see which businesses must get an EIN. You should apply for an EIN early enough to receive the number by the time you must file a return or statement or make a tax deposit. If you apply by mail, file Form SS-4 at least 4 weeks before you need an EIN. If you apply by telephone or through the I.R.S. website, you can get an EIN immediately. If you apply by fax, you can get an EIN within 4 business days. If you do not receive your EIN by the time a return is due, file your return anyway. Write "applied for" and the date you applied for the number in the space for the EIN. Do not use your Social Security number as a substitute for an EIN on your tax returns. You should have only one EIN for a business entity. If you have more than one EIN and are not sure which to use, contact the Internal Revenue Service Center where you file your return. Give the numbers you have, the name and address to which each was assigned, and the address of your main place of business. The I.R.S. will tell you which numbers to use. For more information about EINs, see Publication 1635, Understanding Your EIN. Payee's Identification Number. In the operation of a business, you will probably make certain payments you must report on information returns, discussed later under Information Returns. The forms used to report these payments must include the payee's identification number. If you have employees, you must get an SSN from each of them. Record the name and SSN of each employee exactly as they are shown on the employee's Social Security card. If the employee's name is not correct as shown on the card, the employee should request a new card from the SSA. This may occur, for example, if the employee's name has changed due to marriage or divorce. If your employee does not have an SSN, he or she should file Form SS-5, Application for a Social Security Card, with the SSA. If you make payments to someone who is not your employee, and you must report the payments on an information return, get that person's SSN. If you make reportable payments to an organization, such as a corporation or partnership, you must get its EIN. To get the payee's SSN or EIN, use Form W-9, Request for Taxpayer Identification Number and Certification. For more information, see irs.gov-Form W-9. Caution: if the payee does not provide you with an identification number, you may have to withhold part of the payments as backup withholding. For information on backup withholding, see the instructions for the requester of Form W-9 and the general instructions for certain information returns. Designating a tax year. You must figure your taxable income and file an income tax return based on an annual accounting period called a tax year. A tax year is usually 12 consecutive months. There are two kinds of tax years. 1. A calendar tax year is 12 consecutive months, beginning January 1st and ending December 31st. 2. A fiscal tax year is 12 consecutive months, ending on the last day of any month except December. A 52-53-week tax year is a fiscal tax year that varies from 52 to 53 weeks, but does not have to end on the last day of a month. If you file your first tax return using the calendar tax year, and you later begin business as a sole proprietor, become a partner in a partnership, or become a shareholder in an S corporation, you must continue to use the calendar year unless you get I.R.S. approval to change it, or are otherwise allowed to change it without I.R.S. approval. You must use a calendar tax year if you keep no books or records, you have no annual accounting period, your present tax year does not qualify as a fiscal year, or you are required to use a calendar year by a provision of the Internal Revenue Code or the income tax regulations. For more information, see Publication 538, Accounting Periods and Methods. If you have never filed an income tax return for your business, you can adopt either a calendar tax year or a fiscal tax year. Although some partnerships and S corporations must use a particular tax year. See Publication 538 for more information. You adopt a tax year by filing your first income tax return using that tax year. You have not adopted a tax year if all you did was one or more of the following: filed an application for an extension of time to file an income tax return, filed an application for an employer identification number, or paid estimated taxes for that tax year. Once you have adopted your tax year, you may have to get IRS approval to change it. To get approval, you must file Form 1128, Application to Adopt, Change, or Retain a Tax Year. You may have to pay a fee. For more information, see Publication 538. Choosing an accounting method. An accounting method is a set of rules used to determine when and how income and expenses are reported. You choose an accounting method for your business when you file your first income tax return. There are two basic accounting methods. 1. The cash method. Under the cash method, you report income in the tax year you receive it. You usually deduct or capitalize expenses in the tax year you pay them. 2. The accrual method. Under an accrual method, you generally report income in the tax year you earn it, even though you may receive payment in a later year. You deduct or capitalize expenses in the tax year you incur them, whether or not you pay them that year. For other methods, see Publication 538. If an inventory is necessary to account for your income, you must generally use an accrual method of accounting for purchases and sales. Inventories include goods held for sale in the normal course of business. They also include raw materials and supplies that will physically become a part of merchandise intended for sale. Inventories are explained in Publication 538. Certain small business taxpayers can use the cash method of accounting and can also account for inventoriable items as materials and supplies that are not incidental. For more information, see Publication 538. You must use the same accounting method to figure your taxable income and to keep your books. Also, you must use an accounting method that clearly shows your income. In general, any accounting method that consistently uses accounting principles suitable for your trade or business clearly shows income. An accounting method clearly shows income only if it treats all items of gross income and expense the same from year to year. When you own more than one business, you can use a different accounting method for each business if the method you use for each clearly shows your income. You must keep a complete and separate set of books and records for each business. Once you have set up your accounting method, you must generally get IRS approval before you can change to another method. A change in accounting method not only includes a change in your overall system of accounting, but also a change in the treatment of any material item. For examples of changes that require approval and information on how to get approval for the change, see Publication 538. Business taxes. The form of business you operate determines what taxes you must pay and how you pay them. The following are the 4 general kinds of business taxes: income tax, self-employment tax, employment taxes, and excise taxes. See Table 2 for the forms you file to report these taxes. You may want to get Publication 509. It has tax calendars that tell you when to file returns and make tax payments. Income tax. All businesses except partnerships must file an annual income tax return. Partnerships file an information return. Which form you use depends on how your business is organized. See Table 2 to find out which return you have to file. The federal income tax is a pay-as-you-go tax. You must pay the tax as you earn or receive income during the year. An employee usually has income tax withheld from his or her pay. If you do not pay your tax through withholding, or do not pay enough tax that way, you might have to pay estimated tax. If you are not required to make estimated tax payments, you may pay any tax due when you file your return. Reminder: if your business is an LLC, how you elected to have the LLC treated for tax purposes, either as a corporation, partnership, or as part of the LLC owner's tax return, will determine what taxes you must pay and what forms you should use to pay your taxes. Estimated tax. Generally, you must pay taxes on income, including self-employment tax, discussed next, by making regular payments of estimated tax during the year. For sole proprietors, partners, and S-corporation shareholders, you generally have to make estimated tax payments if you expect to owe tax of $1,000 or more when you file your return. Use Form 1040-ES, Estimated Tax for Individuals, to figure and pay your estimated tax. For more information, see Publication 505, Tax Withholding and Estimated Tax. For corporations, you generally have to make estimated tax payments for your corporation if you expect it to owe tax of $500 or more when you file its return. Use Form 1120W, Estimated Tax for Corporations, to figure the estimated tax. You must deposit the payments as explained later under Depositing Taxes. For more information, see Publication 542. Self-employment tax. Self-employment tax, or SE tax, is a Social Security and Medicare tax, primarily for individuals who work for themselves. Your payments of SE tax contribute to your coverage under the Social Security system. Social Security coverage provides you with retirement benefits, disability benefits, survivor benefits, and hospital insurance or Medicare benefits. You must pay SE tax and file Schedule SE, Form 1040, if either of the following applies. 1. Your net earnings from self-employment were $400 or more. 2. You had church employee income of $108.28 or more. Use Schedule SE Form 1040 to figure your SE tax. For more information, see Publication 334. Tip: you can deduct a portion of your SE tax as an adjustment to income on your Form 1040 or 1040 SR. The Social Security Administration, or SSA, time limit for posting self-employment income. Generally, the SSA will give you credit only for self-employment income reported on a tax return filed within 3 years, 3 months, and 15 days after the tax year you earned the income. If you file your tax return or report a change in your self-employment income after this time limit, the SSA may change its records, but only to remove or reduce the amount. The SSA will not change its records to increase your self-employment income. Employment taxes. This section briefly discusses the employment taxes you must pay, the forms you must file to report them, and other forms that must be filed when you have employees. Employment taxes include the following: Social Security and Medicare taxes, federal income tax withholding, and federal unemployment or FUTA tax. If you have employees, you will need to get Publication 15, Circular E, Employer's Tax Guide. If you have agricultural employees, get Publication 51, Circular A, Agricultural Employer's Tax Guide. These publications explain your tax responsibilities as an employer. If you are not sure whether the people working for you are your employees, see Publication 15-A, Employer's Supplemental Tax Guide. That publication has information to help you determine whether an individual is an employee or an independent contractor. Also, people who provide a service generally associated with the sharing or on-demand, gig or access economy are, under certain circumstances, independent contractors. An independent contractor is someone who is self-employed. Generally, you do not have to withhold or pay any taxes on payments to an independent contractor. If you wrongly classify an employee as an independent contractor, you can be held liable for employment taxes for that worker, plus a penalty. Federal income, Social Security, and Medicare taxes. You generally must withhold federal income tax from your employee's wages. To figure out how much federal income tax to withhold from each wage payment, use the employee's Form W-4, discussed later under Hiring Employees, and the methods described in Publication 15T, Federal Income Tax Withholding Methods. Publication 15T provides instructions about how to apply Form W-4 to calculate withholding on the employee. Social Security and Medicare taxes pay for benefits that workers and their families receive under the Federal Insurance Contributions Act, or FICA. Social Security tax pays for benefits under the old age, survivors, and disability insurance part of FICA. Medicare tax pays for benefits under the hospital insurance part of FICA. You withhold part of these taxes from your employee's wages, and you pay a part yourself. To find out how much Social Security and Medicare tax to withhold and to pay, see Publication 15. Report these taxes on Form 941, Employer's Quarterly Federal Tax Return, or Form 944, Employer's Annual Federal Tax Return. Farm employers use Form 943, Employer's Annual Federal Tax Return for agricultural employees. Federal Unemployment or FUTA Tax. The federal unemployment tax is part of the federal and state program under the Federal Employment Tax Act, or FUTA, that pays unemployment compensation to workers who lose their jobs. You report and pay FUTA tax separately from Social Security and Medicare taxes and withheld income tax. You pay FUTA tax only from your own funds. Employees do not pay this tax or have it withheld from their pay. Report federal unemployment tax on Form 940, Employer's Annual Federal Unemployment FUTA Tax Return. See Publication 15 to find out if you can use this form. Hiring employees. Have the employees you hire fill out Form I-9 and Form W-4. You must verify that each new employee is legally eligible to work in the United States. Both you and the employee must complete the U.S. Citizenship and Immigration Services, USCIS, Form I-9, Employment Eligibility Verification. You can get the form from USCIS offices or from the USCIS website at uscis.gov. Call the USCIS for more information about your responsibilities. Each employee must fill out Form W-4, Employees Withholding Certificate. You will use the information provided on this form to figure the amount of income tax to withhold from your employee's wages. For more information, see Publication 15T. Form W-2 Wage Reporting. After the calendar year is over, you must furnish copies of Form W-2 Wage and Tax Statement to each employee to whom you paid wages during the year. You must also send copies to the Social Security Administration. See Information Returns for more information on Form W-2. Excise taxes. This section describes the excise taxes you may have to pay and the forms you have to file if you do any of the following: manufacture or sell certain products, operate certain kinds of businesses, use various kinds of equipment, facilities, or products, receive payment for certain services. For more information on excise taxes, see Publication 510, Excise Taxes. The federal excise taxes reported on Form 720, Quarterly Federal Excise Tax Return, consist of several broad categories of taxes, including the following: environmental taxes, communications and air transportation taxes, fuel taxes, tax on the first retail sale of heavy trucks, trailers, and tractors, manufacturers' taxes on the sale or use of a variety of different articles. There is a federal excise tax on certain trucks, truck tractors, and buses used on public highways. The tax applies to vehicles having a taxable gross weight of 55,000 pounds or more. Report the tax on Form 2290, Heavy Highway Vehicle Use Tax Return. For more information, See the instructions for Form 2290. If you are in the business of accepting wagers or conducting a wagering pool or lottery, you may be liable for the federal excise tax on wagering. Use Form 730, Monthly Tax Return for Wagers, to figure the tax on the wagers you receive. Use Form 11C, Occupational Tax and Registration Return for Wagering, to register for any wagering activity and to pay the federal occupational tax on wagering. Depositing taxes. You generally have to deposit federal employment taxes, certain excise taxes, corporate income tax, and S-corporation taxes before you file your return. You must use an electronic funds transfer or EFT to make all federal tax deposits. Generally, an EFT is made using the Electronic Federal Tax Payment System, or EFT-PS. If you don't want to use the EFT-PS, you can arrange for your tax professional, financial institution, payroll service, or other trusted third party to make electronic deposits on your behalf. Any business that has a federal tax obligation and requests a new EIN will automatically be enrolled in EFTPS. Through the mail, the business will receive an EFTPS PIN package that contains instructions for activating its EFTPS enrollment. Penalties. The law provides penalties for not filing returns or paying taxes as required. Criminal penalties may be imposed for willful failure to file, tax evasion, or making a false statement. If you do not file your tax return by the due date, you may have to pay a penalty. The penalty is based on the tax not paid by the due date. See your tax return instructions for more information about this penalty. If you do not pay your taxes by the due date, you will have to pay a penalty for each month or part of a month that your taxes are not paid. For more information, see your tax return instructions. If you do not withhold income, Social Security or Medicare taxes from employees, or if you withhold taxes but do not deposit them or pay them to the I.R.S., you may be subject to a penalty of the unpaid tax plus interest. You may also be subject to penalties if you deposit the taxes late. For more information, see Publication 15. The following penalties apply if you are required to file information returns. For more information, see the general instructions for certain information returns. A penalty applies if you do not file information returns by the due date, if you do not include all required information, or if you report incorrect information. A penalty applies if you do not furnish a required statement to a payee by the due date, if you do not include all required information, or if you report incorrect information. These penalties will not apply if you can show that the failures were due to reasonable cause and not willful neglect. In addition, there is no penalty for failure to include all the required information, or for including incorrect information if you correct the errors by August 1st of the year the returns are due. To be considered de minimis, the number of returns cannot exceed the greater of 10 or 0.5% of the total number of returns you are required to file for the year. There is also no penalty and no need for a corrected return to be filed for incorrect dollar amounts, where no single amount differs from the correct amount by more than $100, $25 for tax withheld. If you do not include your taxpayer identification number, SSN or EIN, or the taxpayer identification number of another person where required on a return, statement, or other document, you may be subject to a penalty of $50 for each failure. You may also be subject to the $50 penalty if you do not give your taxpayer identification number to another person when it is required on a return, a statement, or other document. And now that we've paid our taxes and avoided penalties, I think we'll end this evening's reading from I.R.S. publication 583, Starting a Business and Keeping Records. I have no idea how many hundreds of publications the I.R.S. publishes, but this was half of one of them. If by some twist of fate you're still awake and would like something else to do besides think about taxes, perhaps you'd consider leaving us a rating or review on Apple Podcasts or the podcast player of your choice. It does help people find us, and it's much appreciated. If you'd like to connect or suggest a boring book you'd like to hear read, the best place to catch me is on Twitter at BoringBooksPod, or send me an email via our website, boringbookspod.com. I always love hearing from you. Thank you so much for joining me for this evening's reading. Until our next boring book, good night.